Hi, this is Professor Karen Lin. In this video, we are going to answer this question, why do we need accounting? Let's get started. The first question we are going to answer is, where do companies get money from, or how do companies fund themselves? There are two parties involved when talking about how companies fund themselves: creditors and stockholders or shareholders. Stockholders refers to those parties or individuals who own the stocks of the company. So by purchasing the stocks from the company, the shareholders provide money to the company for operation. In return, shareholders got potentially dividends, which means the distribution of the profits from the company back to the shareholders as a return for their investment. Or they could obtain higher future stock prices when the stock prices goes up in the market. On the other hand, creditors provide funding to the companies through different types of loans. For example, the banks. The banks lend money to the companies and potentially looking for returns in the form of interest. We are going to talk about these two parties during the semester when we follow through the materials. The second question is, who owns the company and who runs the company? Now we know that the shareholders and creditors, they fund the company. Shareholders owns the company and creditors provides funds in the form of loans. But managers are the people who runs the company. So for example, we heard about CEOs in the media all the time. CEOs basically are managers who run the companies. Now pay attention that the shareholders or the creditors, they do not run the company because they don't participate in the daily operations. For example, if you purchase 5 shares of the Apple stock, you are unlikely to go to the meetings of Apple and as such, because you have a full-time job, obviously. Now, who runs the company would be the CEOs, CIOs, CFOs of Apple. Here is the problem. Now, suppose you are the shareholder or you are the bank who funds the company, and there's someone else who runs the company instead of you. Now, would you worry about that this person, if he or she is not honest enough, would run away with the money that you provided to him or her? This is a very natural question. How do we make sure managers won't run away with the capital that the capital providers provided? The answer lies in that the managers are required to provide financial reports so that the shareholders, creditors, government, banks, IRS, etc. knows the company's financial status. Therefore, any cheating behaviors will be detected and will be regulated. Now here is where accounting kicks in. Accountants help the company to provide the financial records and reports to the outsiders, or what we call the stakeholders, including the shareholders, the creditors, the governments, regulators, and so on. The stakeholders want to know the financial status of the company, and the accountants provide those information. So typically, a company's accounting system includes 2 parts. The first part is the financial accounting component, which we have been just talked about. Financial accountants provide periodic financial statements and related disclosures to external decision makers. For example, investors, which is the shareholders, and the creditors. Another portion of the accounting system relates to internal decision making, which is managerial accounting, which you'll be learning in the next course in the series of accounting courses. So in this semester, we are only going to focus on the financial accounting components, which provides information for external decision making. The main output of the financial accounting system are the 4 financial statements that a company usually provides: balance sheet, income statement, statement of stockholders' equity, and statement of cash flows. In this week, we are going to focus on balance sheet, income statement, and statement of stockholders' equity, as well as the accounting equation behind those statements. The textbook provides a summary of the 4 basic financial statements which you should read and understand each of the financial statements. In the next few videos, I'm going to introduce balance sheet, income statement, and statement of stockholders' equity to you. I'll see you in the next video.